That's aggressive.
Wow.
Wow.
Eric.
We're talking about the real estate market. It's getting hot, right?
I like your style.
This is a jam back in the day, guys.
Man, and that coupled with a hailstorm, huh?
Yeah, last night hit Tacoma pretty
Maybe it's
hard.
cooling down. I don't know. I hope it cools down quick because, anyways. Ryan Leopold joins us. And, one thing that is hot is mortgages again because, well, they've hit all-time lows.
Once again, all-time lows.
We are broken records. Ryan, how you doing, buddy?
I'm doing great. How you doing, Ben?
I'm good, man. So what is it? We literally, I think ever since I started this show over a year ago, we have continually just said we are at record low mortgage rates. Mm-hmm. And what does it mean? What does that mean, Ryan? What do you think that means?
Well, I think that, it's kind of, like Rice was saying, it's hard to kind of predict what the future is going to be and kind of forecast where interest rates are going to be. All we can really understand is where they are now, which it seems like interest rates keep getting lower. I mean, we're not getting a lot lower than they've been in the last couple of weeks, but still, they're still at or below they've been every day so far this year, if not slightly below. So it's an unbelievable opportunity for people to take advantage of these low rates when they're buying and when they're trying to refinance. It's incredible. It really is.
And, it's even the people who thought they were fine at 4.5 or 4 3/4, it's changing because now you can get down a full another percent.
Yeah, and we're doing it every day. And we've talked about it a couple of times, I'm actually surprised that more people are not recognizing that. We're reaching out to our past clients quite a bit, but I think just the public in general needs to realize that even if they're in the 4s already, that half to a full point really can make a huge deal, especially over the life of a loan. So it's pretty significant.
It's, I was talking with some people about this, and it seems as if some people they're kind of like, I'm done. I'm at 4.5. I'm sick of the process.
Yeah, we see that too. They just don't want to go through the process again. So I think it's that balance of weighing out the benefit and the cost versus, I guess, the perceived hassle of going through doing a refinance again. So, I think a lot of the time that comes down to the lender you choose and the system they put together for you. And, it's tougher than it's been in the past, but I think it's not that bad if you're structured and you get kind of everything up front.
Yeah.
So it doesn't have to be bad.
Well, no, I mean, it's very good. Think about it. You're talking about interest rates at 3.5%. 3.5%.
Yeah, and I still think people don't really recognize that the HARP program's out there. So if someone does not have the traditional 20% equity and they're at all underwater and they meet some parameters, they can still refinance with the HARP program. FHA went through some major changes where if you have a current FHA mortgage that was originated prior to May of 2009, I mean, really the fees have pretty much all been eliminated on that program. So that's a great opportunity for people to lower their interest rate quite a bit. Because if they originated prior to 2009, they're in 5 to 6% on a 30-year fix easily, and now you're getting below 4. So that's a pretty big deal.
All right, so that's the good.
That's the good news.
Let's talk about the bad, because I think banks, as I said, are pouring mud all over themselves again.
Yep.
Maybe not the banks themselves, but, in the words of Mitt Romney, corporations are people, so the people who are running those corporations must really be people, because they're like blood and flesh and bone. And now you see this thing going on with the LIBOR scandal, which we hit on a little bit last week. And I'm blown away with how many people have no clue what we're about to talk about.
Yeah.
Because apparently the Tomcat divorce is getting all the press.
It is pretty amazing. But, I think first, I guess we'll talk about what exactly happened and understand that it doesn't affect people right away because they haven't felt the effects. But I think the underlying issue we're dealing with here is really the egg on the face of these big banks that are continue to be engulfed in scandal. And this one's unbelievable to me. So let's try to make this untechnical as we can. Okay. So one of the major indices, we'll try to make it as simple as we can. One of the major indices that are out there that determine interest rates for mortgages, for a lot of adjustable rate mortgages, student loans, credit cards, and cars is what's called the LIBOR index.
The London Interbank Offering Rate.
That's correct. So really what happens is you have the top 12 to 16 banks, okay? They come out and they have a daily trading rate of what the cost is for banks to loan money to each other, okay? And they take off the top third, they take off the bottom third, and they come up with a daily average between these 12 to 16 banks. And that comes up with what banks, again, charge each other to borrow money. And today that index is about 1.07%. Okay. So to put it in mortgage terms, if someone had a 5-year ARM that they originated, say, in 2003, that interest rate is fixed for 5 years. Then after 2008, that 5-year period, that ARM is now going to adjust. And most of those are based on that LIBOR index. So you take that LIBOR index and add a margin to it, which is usually a fixed margin of about 2.5%. So that would make your new interest rate about 3.37%, 3.32%. Okay. So what they're saying is the banks actually conspired to add a premium to that index from the years 2005 to 2009 that in theory cost people billions, if not trillions of dollars, that they were basically overcharged because this conspiracy between these major banks.
And the amazing part is that most people would never recognize it because if it's a small percentage in your credit card, you don't notice the extra 001 and the extra $1.50 maybe you're being charged.
Yeah.
But
I mean, those things, I guess, if it's not really affecting people on a day-to-day basis, they don't really notice it. But when it comes to trillions of dollars in fees that are added to millions of people across the world, that's where it creates significant revenue for banks.
Huge. I mean, and it's literally siphoning money off the top from people who do not know they're being siphoned.
Yeah, so Barclays, the CEO and the COO of Barclays was actually fined. They resigned amidst a scandal, and Barclays Bank was fined $453 million. But the question is, how many more banks are involved in this? Because you can't have one bank involved in this. There has to be multiple banks. Because if you're taking the bottom third and the top third off, and you're coming up with an average, you're going to have multiple banks involved. So that's going to be interesting what comes out with that. I know JP Morgan and Citi, they're all being investigated as well. So, just another day in the banking world.
Yeah, right. No kidding. And then, you have these things. It seems like the banks put their best car salesman out on you, and they're talking to you like everything's going to be great. And then all of a sudden, when the rubber meets the road, the car doesn't quite work the way you wanted. What the banks are doing, what the programs they release just don't quite run the way maybe they were told to people. And I mean, the same thing could be said to mortgage brokers from, years ago before anybody had to get licensed or anything. You just go out and slang some mortgages. Mm-hmm. But, they didn't always work the way some mortgage brokers told them.
Right.
Well, now it's a much bigger used car salesman who isn't always telling people how things are going to work.
Right. Well, I think it's just behind the scenes, ways to kind of find different ways to skim money from people, trillions of dollars that they just think that they're not going to find out about it. And when they do find out, it's just another major issue for these banks and major distrust that people have already in the banking community, but now it's just that much worse.
Let's talk about HARP, because that's something that's happening again then with HARP refinances.
Yeah, so we've talked about that a couple times as well. So the good side is that HARP is still available, helping a lot of people refinance and take advantage of these lower rates, even if they don't have the traditional 20% equity. If their loan is owned by Fannie and Freddie and it was originated prior to June of 2009, for a lot of cases they qualify. But I think, and again, Fannie and Freddie are 98% is owned by the government. So they came out with these programs to help the American people refinance and to kind of minimize the foreclosure rates in this country. Okay, so that was supposed to be the merits of the program. They had HARP 1 that didn't work out as planned. Now they have HARP 2, and because of the overlays that Fannie and Freddie are putting on the banks and pretty much every mortgage bank that's out there, that a lot of lenders are scared to do a lot of these loans. So now you're seeing tons of limitations, especially on the Freddie side, where someone's coming in that are maybe 50% underwater in their home, and per the guidelines of HARP, they should be able to refinance, but because of these overlays that banks are having to put on there, because of the risk of these mortgages, we have a huge percentage of people who cannot take advantage of the program. And so that's one aspect of the negative side of HARP.
And the people who can take advantage, they have to go back to their bank.
Now, in some cases, so I'd say there's probably a percentage that most banks or most mortgage companies can help the consumer. But then you have another percentage where maybe they're higher loan to value, maybe they don't have perfect credit, maybe they had a couple late payments, or maybe they had a foreclosure in the past, or maybe they simply had a change in income where they don't meet traditional debt to income ratios, where the only one that can help them is the original servicer of the loan. So it's Bank of America, Wells, or Chase, or Citi. That's the only place they can go. And because the banks know that, they're putting a premium of 3/8 to 3/4% in rate onto those programs simply for the fact that they know that they're the only shop in town that can service those clients. That's not a risk-based pricing model. That simply is more of a monopoly type situation. And that's, again, making these banks tons of money at the cost of the consumer.
And it's these small basis points that people don't always recognize.
Yeah.
And it's kind of similar to the LIBOR. They jack it up a little bit. They jack up your interest rate just a hair. You're still saving money, but it's just a little bit higher than what they could do. And that's where you start getting into some of the problems that people have. It's, you expect the bank to be doing something, but they're doing something else. And you go deposit your money, you think something's going to happen. It's amazing to think that they can be so non-transparent and not have to tell you what's going on when it's really your money that they're dealing with.
Well, we talked about it a couple weeks ago that it's amazing that the estimates of the banks, these four major banks, are going to make well over $12 to $15 billion in revenue from HARP proceeds in 2012. Over $12 billion. And they're also assuming, the estimates say that the consumer is going to save between $2 and $5 billion from the savings they're getting from refinancing these loans. So what a huge moneymaker these banks are getting off this program. And that's not necessarily the issue. The issue is when they're not, they're making a monopoly of it and not protecting the consumer and reward, giving the consumer what they deserve, which is the competitive interest rates, because they can't go out and shop them anywhere else.
Ryan, certainly it's good information. Again, we have to go to break. But we're going to come right back. We're going to continue the conversation on real estate and what's going on and maybe get into some more mortgage. I'm Ben Brashen. That's Ryan Leopold. You're listening to Brashenomics.